Welcome back. You're still tuned into Mid-Cap Radar. Well, Nifty steady where it was when we started the show as well, but some stocks like MIC Electronics, that's higher. That's up almost 18.5% right now. Atul Auto is the other one. Aditya Vision is a stock which is surging. It's up around 10%. And a lot of movers on the back of the GST rate cut announcements that have come by as well. So let's do one thing. We've spoken about how these GST rate cuts would impact specific companies, specific stocks. But what is the impact on GDP overall? How does it impact macros? Let's get in a conversation going. Sakshi Gupta, Vice President and Senior Economist, HDFC Bank. And we're also joined by Kanika Pasricha, who's the Chief Economic Advisor, Union Bank of India. Ladies, good afternoon. Thank you so much for joining in. Sakshi, let me start with you. It is largely in line what was expected. What are your GDP targets for FY26, FY27? Do you think the government has given an estimate of how much GDP will be impacted? What kind of changes are you seeing to your GDP targets? Which are the specific sectors which will see a lot of impact because of this?
No, thank you for having me on the show. Look, of course, the GST announcement that has come in is clearly going to be positive for consumer demand. Particularly, I think, for the lower and middle segments of the income pyramid. Right? So if you look at, the benefit of the GST rate cuts, especially the move from 12% rate to 5% rate, which is coming in a lot of the food, beverages and essential items, I think this is something that benefits, the middle and the lower middle, income segments. And to that extent, we do see that this will have a positive impact of about, 15 to 20 basis points positive on our GDP growth estimate for the year. Our baseline currently was 6.3%. So because of this GST announcement, we do see a positive impact there. I think this is something that will play out, not just in the near term, but I think over the next 12 months. We could, in the second quarter, we could, see some postponement in demand and demand starting to pick up, end of September when these GST rates come into effect. But Q3, I do, of course, expect that there's going to be a pent-up demand effect and, that playing out on the consumption side. I think this comes at a time when for households over the last couple of quarters we have seen that because of high inflation and of course slow wage growth, we had started seeing consumption kind of slow down. So in that context, definitely this is a positive booster for demand.
Right. Well, Kanika, let me also bring you into this particular conversation. Clearly we are seeing a shift in stance from the government as well as RBI. Earlier, it was all about capex and the kind of boost that we were seeing towards the industrial sector. This time around, we've seen three key moves, right? We've seen personal tax rates getting cut, we've seen RBI cutting rates, and now we're seeing the GST kicker. FY26, FY27, what kind of growth rates are you penciling in? And has, both Centre as well as RBI exhausted all the arsenal as far as their own armory is concerned?
I would say let's be optimistic. Let's not think that they've actually exhausted all their arsenal. There's still a lot more to go. In fact, there's been consistent discussion by the government and RBI to think of more policy proposals to support the economy. So first, compliments to the government. They have given us a GST rate cut and completely agree with Sakshi. It's a demand booster. Given the kind of items that have been lowered from 12 to 5% and 28 to 18%, though the high-end premium or luxury segments have been raised, the base rate has come up from 28 to 40% for a luxury car, though the net rate comes down still from 45% effective tax rate to 40.
Right.
For your premium travel also goes up from 12 to 18. Now, quickly on your question, policy space. See, we think that, yes, after income tax rate cut and the RBI rate cuts, plus the GST reform, just purely basing on GST, agree with Sakshi's number of 10 to 20 basis points. In fact, the number can only be higher if the ease of doing business segment and the tax compliance improvement segment actually gives us much more dividend the way it has been given in case of income tax in the last few years. But last but not the least, purely the growth number for the year, which be up to 6.5% to align with MPC after the 7.8% booster shot for Q1, which was primarily front-loaded growth. Another factor which we can't ignore in growth is the US-India trade deal stalemate, which actually affects 1% of GDP, around $45 billion across sectors like shrimps, textiles, gems and jewelry, auto components, chemicals. That itself has to be taken into account as well, which is why after this number, we'll not be upping our forecast. It's a close wait and watch, 10 to 20 basis points. So this year, 6.5%. I would say with a downward bias, if the disruption remains for longer, salutary effect provided by the government, definitely. And RBI also may probably add with another 25, 50 basis points token rate cut. Next year, purely on base effects, some upping can happen, but broadly trend forecast, trend GDP's mapping in terms of its decadal trend of 6.5%, and may stay there. Thanks.
Got it. Thanks for that perspective, Kanika. Sakshi, let me come to you. We've spoken about the growth perspective, but now that we're putting in more money in the hands of consumers, what is the impact on inflation? What are your targets in terms of how it would impact that number?
Right. So look, on the inflation front, there are a couple of things, right? If you look at the new revised rates on GST, then de facto, that brings, a downside, impact on our overall inflation forecast for the year, which could be, anywhere between 60 to 80 basis points. However, I don't think that that's going to be, fully passed through. So assuming, that 50% of the benefit is actually passed on in a very graded manner to, consumers, I would at this stage see a downside to my annual inflation forecast of 2.8%. And the downside could be anywhere between 10 to 15 basis points. My forecast was already lower than what the RBI is expecting for FY26. The second thing, I think you were hinting more at the fact that, look, if there is going to be a pickup in consumption, does that end up being inflationary in nature down the line, right? So from that perspective, I think that, for now, at least the problem has been that consumption has been very low. Capacity utilization rates in the economy have also been, across sectors between 70 to 75%. So I don't think that we are anywhere near a situation where there is heating up in the economy that can happen, that can lead to a, upside inflationary impact. So at least for this year, I think this GST announcement is actually going to pull down the overall inflation number.
Sakshi, a quick follow-up question. Now, between the center and the states, almost 3 to 8% of budgeted GST revenues would be impacted, right? So
Right.
in that context, how do you see that getting offset? What do they have in their arsenal to go ahead and equip themselves to offset these laws?
Right. I think, if you heard the press conference yesterday, the Revenue Secretary, did mention that the revenue impact of this GST announcement is close to, 48,000 crores. I think that is not an extremely high number at this stage. And I think they are relying on the fact that there will be some buoyancy on the tax front. My sense on the fiscal side at this point is that, look, the overall GST revenue number seems to be high. We have some cushion from, things like a higher RBI dividend that we got this year. Also, the government seems to be making a little bit headway on the disinvestment front. So I would at this stage expect perhaps some amount of expenditure rationalization if required to balance the fiscal math, at least at the center level, and for them to kind of achieve their fiscal deficit target.
Got it. All right. Sakshi and Kanika, it was a pleasure speaking with the two of you and understanding what the impact on macros could be and the overall picture as well. But for now, we'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side. Stay tuned.